You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the Insurance Company Financial Review. And on today's show, the company's insurance items with special co-host, certified financial planner and CPA, Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me, day 4, Mr. CLU, CHFC, CFP, and CPA, Ken Davis.
Stephen, good to see you.
And my friend from the heart.
We are.
Okay.
We've been a long time, since the early 90s.
Oh my gosh, I remember when we both looked considerably younger. And
Well, you know, I was just reflecting on that a little bit. The fact is that Vital Signs and the software we're talking about and the data and stuff was being a CPA and being a lot more geeky back then. I still had copies of the Internal Revenue Code in my desk back then.
believe it.
When you brought up Vital Signs and all this financial data, your cachet went through the roof. It's like, oh my gosh, this guy, look at the detail and the financial information. This guy is not your normal insurance brokerage guy, and that's one of the things that actually piqued my curiosity in building a relationship with you in the first place.
I was all over this stuff way back in the day when nobody was really looking at this, and the only reason was because I was concerned about the client's best interest in the contract that we sell a client is only as good as the company behind it.
Well, and I think, you know, we focus on the large client and the competition and how important these kinds of details are in winning the competition when there's dozens of agents, there's huge premium, there's gatekeepers involved. I mean, this is pretty clear and obvious that this can help a lot. But I think on a day-to-day basis, just serving our clients, the moms and pops, I've been in the business a long time, and I've seen markets go down, and I sure don't feel good sitting on the other side of the table when everything's tanked. And 2008 was a very scary time. So if I've got really strong companies, and if I've done my work and gone beyond just the ratings, that allows me to stand tall. It allows me to have a much better conversation with my clients. So yes, this is important for big clients, but it just makes for better relationships, and it makes you feel better about what you do on a day-to-day basis.
Well, when I'm looking at some of the statistics, when I'm looking at life insurance, I mean, I'm looking at their total amount in force. What kind of ultimate liability do they have? Now, not everybody dies at the same time.
Right.
These people. I mean, can you imagine if you took the top 10, maybe 11 companies, I might even be too big here, maybe the top 7 to 10 companies, their total death claims would supersede the U.S. debt.
Wow.
I just want you to get the gravity of what's in force.
Yeah.
And I'm only using the top 10 carriers. I'm not using all of them. I mean, you want to pay off the $17 trillion U.S. debt? Have everybody assign their death benefit to the government. Done. And that's my first call for a national life insurance. Everybody has to have it.
Well, I think everybody will stop their premium and let the policy lapse if that happens. And don't give the congressman these ideas, Steve, of confiscating our assets. They've already been looking at the 401ks.
I just want to help somehow. Okay. Well, when I'm looking at it, one of the things I look at it, and this is in Vital Signs, is this thing called total insurance in force, and then it also shows the total reinsurance ceded. Now, if you're saying, Steve, I'm not really sure what I know. Well, retention is the company's ability to take on a risk without any sharing in reinsurance pools or other carriers.
So they can make special choices. They can decide, gee, it's year end, we want to goose up our sales for the year to hit our bonuses. We're willing to take a little more risk, and that's just a business choice. But if they've got partners of reinsurance on these large cases, they won't be allowed to do that.
They have to follow the protocols of what the reinsurance treaty is. Now,
right.
Ken, you just brought up a very, very mercenary thought coming from Ken. It surprises and
I've been
shocks
hanging
me.
around you too long, Steve.
Oh my gosh. Well, yes, in the fourth quarter, Steve looks up everybody's retention. I mean, we're trying to close cases. Fourth quarter is kind of that unspoken truth that impaired risk cases are going to get better treatment at the last 60 days of the year. And I'm sorry, but my pattern to date proves that that's true. However, I always like to look at reinsurance because then protocols, underwriting requirements, it's up for negotiation. And so if I'm staying within the carrier's retention, I want to know how much of this business, like in this case, we're looking at $3.5 trillion in force with this carrier. I just probably tipped you off to who it was. And I'm looking at that about half of that amount is going outside. This carrier itself probably has anywhere, and remember, I can't include everything because it's second to die would be in there. Age groups are going to be, you're going to have a small roll off on retention. But when you're looking at 10, 15 million of retention and you're in the fourth quarter, you're playing with the big blue chip companies that can, really make the call. I love things like that.
Well, and not only can they make the call, but when you get gatekeepers involved and you get large premium, clients get real sensitive to the quality of the company.
Oh, yeah.
So if you've got this not only a great rated company, but a highly, major assets, that helps. And then, like we were talking about in the last show, is if they've got a high surplus in AVR, compared to another highly rated company, it's like that's even better because insurance companies are highly leveraged assets.
When I look at this, think about this. When you look at the mix of business, which this tells me, is it life insurance? Is it annuities? Mm-hmm. Are they doing health? Are they doing disability? Are they doing long-term care?
Are they doing variable? Are they doing group products?
Exactly. And by the way, it's going to show separate accounts, so you're going to be able to see all this.
Right.
It's very important to get an analysis of the product mix. This is why we were talking about and lamenting a little bit about the annuity situation, because a lot of carriers that are just annuity providers kind of get, in my view, negatively treated by the rating services just because that's all they do and they want to be diverse. But that's not their business model. By the way, Ken, just a side note, when I'm looking at these numbers and I'm thinking about whole life, universal life, term, now you start to break it down by product line, what's profitable, what's the net operational, all this is in here.
Yep.
So when I'm looking at this, I'm trying to judge, is this carrier doing well? And especially on fourth quarter, if I've seen a flat to negative sales, I might be pushing them a little bit to see if I can get a little bit more out of them. Well, when we come back from the break, we're going to continue talking about company insurance items with co-host Ken Davis. And don't forget to test drive Vital Signs absolutely free by going out to their website, www.vitalsalessuite.com/logins/the biz.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Ebix's Smart Office solution is used by thousands of professionals worldwide. Focused 100% on serving our industry, our proven technology has made us the #1 provider of CRM, practice management, and agency management solutions. Smart Office features include anywhere, anytime web-based capability, on-the-go mobile access, industry-specific functionality, integrations with key industry partners, investment data downloads, robust integrations with other Ebix products, and a high-powered email marketing capability through Constant Contact. Smart Office provides a complete wealth management platform that gives you the tools and flexibility to support your practice today, and an integrated advisor workstation designed to extend your solution as your practice grows. Make Smart Office the center of your practice. Get Smart Office today.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's materials at The Biz. And while you're out there, click on the Backroom Technician icon, which is on the Biz blog, for your 30-day free trial offer for the best needs analysis and educational materials that address almost every financial planning scenario. And just a heads up, before moving forward with anything ideas you hear on our show, always consult your tax advisor and legal counsel, as well as your broker-dealer compliance officer, if you are so FINRA licensed. Ken, we're talking about the insurance issues now on the balance sheet. We talked about retention, automatics. We didn't touch on facultative, but really it's not going to be on the balance sheet that much because we're outsourcing that to another carrier. I'm looking at things like, this has surprised me, I have to say. I'm looking at this carrier, their average face amount, and by the way, this is not last year, this is their average face amount all in, is about $152,000. Now, does that surprise you? That seems so low.
Well, it is low, and I guess maybe they've been around a long time, so there's a lot of old policies, a lot of small children's policies, stuff like that, but still, it is low. And you think, well, gosh, I mean, personally, I can't imagine anybody in America needing less than $500,000 worth of insurance. You know, a 4% distribution on $500,000 is $20,000 a year.
Right.
I mean, middle America needs to have at least that amount. So, I mean, we should be seeing more like $1 million to $2 million. And of course, that's mostly term insurance. But but still, if they have a mix of term insurance and cash value, then that's really where people should be.
When you think I came into this business 30 years ago, we were still using the 1958 CSO mortality tables. I saw a case just recently that was built on the 1941 CSO.
Oh my goodness.
It was such a small case, and back in that day, when you look at the application, that $10,000 policy was a whopper of a case.
You know, it's interesting. I wrote an article on charitable giving, and there's all kinds of tiny little policies that none of us really want to look at or the client doesn't care about sitting in drawers, right? And when that all adds up, these are insurance companies going, wow, this is cool. You know, we are charging those really high rates. Well, if somebody's really involved with a cause, a charitable cause, a church, synagogue, whatever, go grab those little policies out of the drawer and redo them at much lower cost, increase the face, and give it to your favorite charity. You know, it may not mean much to you, but it mean a lot to them. So I mean, stuff like that just sitting there.
It matters. When I'm looking at statistics like this, I'm looking for their 1 year and their 3 year sales production, because it tells me where the company's going. A lot of people always say, well, the industry at large is flat, but I look at the brokerage community, which really owns the vast majority of life sales in the United States. And when I look at numbers like this, there's career shop exceptions to what I just said, but the vast majority. And when I look at that and I see the statistics, I can kind of see where the company's going, their sales. Are they going to have to look at a different distribution? Are they looking at a different distribution? Like Metropolitan, a perfect example. Are they going to be able to be successful selling policies out of Walmart? I don't know. It's way too early.
Well, I guess the other thing is when you get into corporate world and you're doing group policies where it's $10,000 or $15,000 per employee, or you know, protecting mortgages or whatever with a declining, you know, term policy or something, that's going to bring your averages down too.
I love when I'm looking at numbers like return on assets versus return on equity. I love when I see a company pulling down 17% on their equity position. I mean, that's a great double-digit number.
And at the same time, it's 0.7% of assets. So it's interesting. It's like, 0.7%, that's no big deal. But gosh, when you have billions of dollars of assets and you're getting a return on your equity of 17%, that's where that leverage is. We all know that leverage cuts both ways, and when it's used appropriately, can really juice up the returns. And that's what banks and insurance companies are all about, is highly leveraged financial institutions.
On this same document put out by Vital Signs by EBIX, I'm looking at the 2012 lapse ratio of a carrier, and it's 2.3%. I have to tell you, back in 1988, when we changed the TAMRA laws, right? June 21, 1988, a day that I thought was going to be infamous, right? But it turned out to be not that bad. But what we did was, I noticed that that was the greatest 1035 pillage of my entire 30 years. People were just leaving different companies for new products, new edgy issues. Universal Life was just coming online and really becoming a player. And you saw people's lapse ratios or replacement ratios or surrender going through the roof.
Well, and there was another point of the balance sheet that was even more injurious to the insurance companies, and that was they were taking loans on their contracts. We used to be able to loan at 1 or 2 or 3% loan rates, and suddenly money market funds in the back then were like 12, 14, 15%. People were going, oh my God, I can borrow at 2% and go down and put in a money market fund at 15%. The arbitrage was outrageous.
That's why when I look at balance sheet issues like this, I want to know, hey, return on equity, the return on assets, the lapse ratio,
the liquidity.
I mean, all this matters. I mean, especially when you get companies that get stuck. And one thing Ken said earlier in the week, when some of these companies were having problems back in the 90s, and they were taking 60 to 90 days for a check, you got worried. I mean, that's talking about liquidity.
Well,
crunch.
start looking at some of your insurance contracts. I haven't looked at it in years, so I think this is still true. There's actually a provision, and I think it's by law, that they can withhold distributions for, I think, 90 days, and it's for that reason. When you have people borrowing at 2 and getting 15, you're going to have a rate on the bank.
Oh, yeah.
And that's another reason why the liquidity, we were talking about that on the balance sheet earlier, liquidity is really important because there are events like that that cause people to withdraw a lot of money under certain circumstances.
When you think about all the information that is digested in a summary statement off the convention blank or the blue book, however you want to call it, and all this information is ready for you right now, this will help you in some of the biggest cases, especially business, that you'll ever see in your life. We're using Vital Signs by EBIX. I've been using for 22 years because it works. Well, that's our show for today. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve@thebiz. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.